Hello and welcome to BQ Prime. GDP figures for India for the fourth quarter and for the full fiscal year were published yesterday. Now, for a deeper dive into the figures that were published, we're joined by Pronab, ex-chief statistician of India. Sir, thank you so much for taking time out.
It's a pleasure.
So, before I start off with my questions, any quick insights into what you made of yesterday's figures?
Well, it's not really an insight, and the figures are very good.
Yeah.
They're unexpectedly good. I don't think anybody who is in the job of looking at the figures and forecasting expected anywhere near this. We are all expecting around the 5% mark, and this is a full 1 percentage point above that. So that's good news and unexpected good news.
Absolutely. So, to begin with, I would like to understand the divergence we saw yesterday between GDP and GVA figures was not entirely on expected lines. GVA figures were considerably higher than GDP. So, could you help us understand the interplay? Was it lower indirect tax collections, higher subsidy outgo? What did you make of that?
Well, I haven't looked at the figures yet because the difference is really indirect taxes and subsidies, right? So what the figures suggest is either you've had higher, much higher tax collections than the growth of the economy, or there's been a reduction in subsidies, right?
Yeah.
Or some combination of those two. Now, until one looks at the government figures, it becomes a little difficult to be able to say what exactly is going on. And just, we get the central government figures for sure. But the point is that insofar as taxes and subsidies are concerned, state governments have to be looked at as well. And that data is not quite as easily available, at least to us. It's available through the official channels, of course.
Sure. So, capex figures were better than one would have expected, while private consumption was still muted. Would it be correct to believe, just considering other high frequency indicators and whatever our reading of the economy has been in recent quarters, that the capex figure was largely or greatly helped by the government's thrust on capex?
Well, again, that's something one would have to look at a little carefully. Yes, it was certainly helped. But, the thing is that if you look at the government expenditure figures, government capex, particularly of the central government, has been high for the last 2.5 years. And so it's hard to imagine that there would have been so much of an increase. That is because you're really talking about a high figure on what in the past has also been a high figure. So the only assumption that I can make on this is that the state governments, which were going slow on capex, because they were looking at fiscal problems, they may have turned around and started investing a lot more.
Right. And how does this tie in with the muted private consumption growth we saw? So,
This is the big problem. I mean, the real issue is that, what GDP measures is the growth in incomes, right? So incomes in the country went up by 6.1%. But consumption went up only by 3.8%. Now, that is a very large divergence. Right? What you would ideally like to have is that if you have a 6% growth, you would want consumption, or you would expect consumption to be 5.5, 5.7. Okay? And the capex being about that much higher than 6%. But here you've got a situation where the private consumption is significantly lower growth, and private investment is significantly higher. That is a conundrum. And that's something that needs to be resolved. So the CSO has given us the figures. Now it's for us to interpret those figures. This is the economist's job.
Right. So in this case, would it be correct to infer that unless private consumption sees some sort of a recovery going forward, the capex figure we saw might not entirely be sustainable in terms of growth?
Yes, but the question, I think the prior question to that is why is private consumption growing so slowly relative to growth in income? That's, I think, the real question to ask. And I think the answer to that lies in the distribution of incomes. And what it tends to suggest, if you think about it, the poor and the lower middle classes tend to consume a very high proportion of the income that they get. So what it suggests is that the growth hasn't quite benefited them. It has benefited the upper middle class and the upper classes, who tend to save a very high proportion of their incomes. Okay, so what this gap seems to suggest is that the income distribution has become a lot worse.
Absolutely. There are expectations that rural incomes, which so far were actually below inflation, is now expected to see a little bit of an improvement, especially considering we're seeing lower inflation and we're expected to see normal
Well,
monsoons.
well, again, this is where the problem becomes a little tricky. Because if you look at the same numbers, one of the striking features of the GDP numbers is that agriculture has grown at 5.5%, right? Which is way above what we usually expect. Usually we expect between 3 to 3.5. So 5% is a lot higher. And people who get the agricultural income tend to be very high consumers. So one would have thought that most of that additional income being generated from agriculture would have gone into consumption, right? So there is a big question mark in terms of the distribution, which is coming out of this divergence between income growth and consumption growth.
Sure. Okay. Again, do you think there's a little bit of a divergence even between, say, contact-intensive services versus manufacturing? We did see better figures for manufacturing in Q4 after a contraction in manufacturing for 2 previous quarters. But there again, do you think these figures also show that still demand for services continues to outpace demand for goods? How are you reading into that?
Well, as far as demand for services is concerned, there is a large base effect playing out because post-COVID, the demand for services was very muted. For the very simple reason people didn't want to expose themselves to person contact, right? And that fear has gone away, and that is getting reflected in a higher demand for contact services. Right? So trade, hotels, and restaurants, for instance, has grown at nearly 10%. So people are going out, and this is entirely along expected lines. Now, as far as manufacturing is concerned, we knew manufacturing was not doing well, right? And in fact, if you look at the last quarter, the fourth quarter numbers, manufacturing did unexpectedly well again. It grew at 4.5%. Right? Even though for the year it's only a little over 1%. But the fourth quarter has shown fairly, by the standards of the last year and a half, manufacturing has done well.
Okay. Do you also, so like you mentioned, there has been a little bit of a turnaround in manufacturing in Q4. Just considering how there are signs of a little bit of an uneven recovery across some of the other segments, do you believe that the rise we saw in manufacturing could be attributed more to a rise in value over volumes?
Well, the GDP figures are giving us value figures, right? They don't necessarily reflect volumes. And here, the question of value and volume becomes a little problematic because when we say value versus volume, we tend to think of price rise and inflation. Hmm? But there is another dimension of the value volume game, and that is the type of product and the quality of the product. I mean, for instance, if lower end cars are not selling, but high end cars are selling, you can have the same number of cars, right? But the value would be much higher. And this is not a price thing. The prices of both the categories of cars may remain just constant. Right? So again, that tends to reinforce what I said, the belief that what these numbers are telling us is that it is really the higher end products which tend to have higher value per volume that is getting reflected.
So we need some help understanding what's happening in case of deflators, the GDP deflators. So very evidently, FY23 did see a little bit of benefit from easing inflation, right? Both WPI as well as CPI, especially considering WPI's higher weightage and the fact that WPI has seen a consistent decline and is now in contraction. So could you please help explain that?
Well, the WPI and CPI have behaved very differently. So if you remember what was happening all through last year, towards the first half of the year, WPI was growing in the double digits. It had gone up as high as 16%, and then steadily came down, steadily and slowly. And now, the last WPI reading has gone into deflation. But CPI was a little high to begin with, then got a little bit higher, and is only now in the last couple of months it has started to recede. So if you look at last year, you had a situation where CPI was inching upwards and WPI was coming down. Right? Now, everything then depends upon how they are distributed over the quarters, because that's how you add them up when you get the full year's figure.
All right. Okay. And how is the GDP deflator then expected to impact FY24 figures?
Well, the FY24 figures as of now, the GDP deflator would be much lower. Remember, the GDP deflator last year, as we saw from the data that's come in, is upwards of 8%, nearly 8.5%, right? This year, so far, we should be looking at something which is closer to 4.5%.
Sure. Okay. I think another thing, like your opinion on, is the rising disconnect, if you agree, on manufacturing high frequency indicators and the eventual data we see in GDP. So, for instance, the index of industrial production has been consistently weak for most of last year. Which is why, the better than anticipated performance of manufacturing GVA in Q4 did catch us a little bit by surprise.
Yes, but that again really relates to this value versus volume discussion that we just had. So the volume doesn't seem to have increased very much. That's what the high frequency indicators are telling us, particularly the figures that you're getting from IIP and the ASI. But the value seems to have gone up a lot. So again, it tends to suggest that the volume growth has been muted, but it has happened in the upper end. So the lower end of the products have not grown. Upper end of products have grown very strongly, and therefore you're getting this value versus volume disconnect.
All right. Okay. But you think the IIP, because of all of these reasons and others, is not reflecting the true state of the manufacturing industry?
It is
Okay.
reflecting the true state, because
Okay.
at the end of the day, it is the volume which will actually drive employment. It's not so much the value.
Okay.
Right? So if you're interested in employment, then the volume is important. If you're interested in incomes, total income, then the value is more.
All right. So, to conclude, I'd like to know what you see going forward in FY24. We continue to see global headwinds. At the same time, there's definite easing of pressures, improving margins because of lower inflation. So, what's the outlook according to you?
Well, the outlook, yeah, again, things are little hazy as of now. If you look at the figures again, uh, one of the things that can stands out is that our trade side has not done very well. Although over the year, exports and imports have both grown, over the last quarter, they've both declined and declined quite sharply. Now, as far as the exports are concerned, that is completely expected, right? Because of the global weakness. So the rest of the world isn't importing from us as much as they should have. But what is unexpected is the weakness in our imports. So, and that has been quite pronounced. In fact, one of the reasons the GDP has grown so strongly is because imports have dropped very sharply. And that's something we need to worry about a little bit, because what it is saying, in effect, if you think about it, that there has been a disconnect between high growth in India and two things, which earlier were very closely connected with growth. One, of course, was private consumption, which we already discussed. And the third was imports. Usually with high growth, our imports go up much faster. This time it hasn't happened. So again, there are question marks in terms of whether or not this growth is sustainable. Because something is happening in the economy which is unexpected and which requires us to, I think, dig a lot deeper than we have up to now.
So, then does that indicate the need for continuing structural reforms?
Well, until we know the cause fully, it's difficult to argue what kind of measures would have to be taken. So one needs to analyze this disconnect, and that may take a little bit of time, because one then has to really look at longer term data and ask the question, what exactly is going on? And only then can we actually formulate the appropriate policies.
Sure. All right. So, thank you so much for taking time out for us today.
It was a pleasure.